This LOS is determine the value at expiration, profit, maximum loss, break-even underlying price at expiration, and payoff graph of a covered call strategy and a protective put strategy, and explain the risk management application of each strategy. So first we're going to look at covered calls, and a covered call is a relatively conservative strategy, but is also one of the most misunderstood strategies. A covered call is a position in which you own the underlying and sell a call. So think about it. When I buy a call, I've got the right but not the obligation to buy the stock at a certain price. When I sell the call, I've got the obligation to sell, okay? But if I've sold that call and I own the stock, that means I have an obligation to sell the stock at a certain price, the exercise price. Now what's going to happen, let's say I buy a stock at $100. I'll sell that call with an exercise price of maybe $110. So if I get called out at $110, I'm happy. I've locked in a profit of $10 and I've sold the call. I received the premium. If the call expires, if the stock price stays at $100 or below, then I will have received the premium and I've increased my yield. Okay, so that's why it's a relatively conservative strategy. I've sold the call, so I have an obligation to sell, but I own the stock. That's fine. I'll sell the stock and I'll sell it at a price that I'm happy with, and in the meantime I'll collect the premium. Okay, so the writer owns the stock and sells the call. Now what you're trading the upside potential for the option premium. Okay, before I continue with my slides, I just want to point out a resource that is outside the CFA curriculum that I think is very valuable, and it's the Options Industry Council. Okay, on this website, if you Google search Options Industry Council, you come to www.optionseducation.org. Note it's .org. They've got some very good free education. Now you can see that I'm on the tab Strategies and Advanced Concepts, and you can see here that I'm on the long call. The previous LOS we looked at a long call, short call, long put, and short put. All those strategies are here. So for example, if we look at the long call, it's going to give you the maximum gain, maximum loss. It talks about the description with the outlook. Of course, I'm going to be bullish. I want to buy the stock. I've got the right but not the obligation to buy. A little bit about the motivation, valuations, maximum loss, maximum gain, profit and loss, break even, which we recall was the strike price plus the premium on the break even on long call. Volatility, a little bit into the time decay. We don't get into this in CFA level 1 at all. And some comments, okay? And then it's got some related positions. Now, if I just scroll back up, now we're talking about the covered calls. So here you can see I'm just going to click on the covered call. And as I said, this is a nice, sometimes it's good to go outside the CFA curriculum to complement the curriculum. And if you find a good website that gives you good education, then use it. And I think this is one. Okay, so here you can see the covered call, which is you buy the stock, you own the stock, and you write the call. So it gives an example here. You're long 100 shares XYZ and you're short 1 XYZ call at 60. So it's going to scroll through. You can see the maximum gain is the strike price minus the stock purchase price plus the premium received. That makes sense because I have the obligation to sell, and that's the strike price minus the price that I bought the stock at plus the premium. The maximum loss is the stock purchase price minus the premium received, and that could be substantial. Now, covered calls is usually when you have still a fairly bullish outlook. You want to own the stock. You're not hoping that the stock price goes down. Okay, so again, here's a nice little description on covered call. And then it's going to, what is the outlook? The covered call writer is looking for a steady or slightly rising stock price for at least the term of the option. Strategy is not appropriate for a very bearish or very bullish investor. What is the motivation? Prime motive is to earn premium income, which has the effect of boosting overall returns on the stock and providing a measure of downside protection. The best candidates for covered calls are the stock owners who are perfectly willing to sell the shares if the stock rises and the calls are assigned. Okay, stockholders that would be reluctant to part with the shares, especially mid-rally, are not usually candidates for this strategy. Covered calls require close monitoring and a readiness to take quick action if assignment is to be avoided during a sharp rally. Even then, there are no guarantees. So it talks again about the valuations, the maximum loss, the maximum gain. Maximum gains on the strategy are limited. Total net gains depend in part on the call's intrinsic value when sold and on prior unrealized stock gains or losses. Okay. A little bit about the profit and loss. Again, the break even is the starting stock price minus the premium received. A little bit about volatility time decay that we don't really get into in CFA level 1. So again, this is a very nice website with very good information. If we go in, next is going to be the after the long call in this LOS. What we're going to look at, the protective put. So we can just scroll down and we can see here's the protective put. Same thing. Okay, it's going to give you a nice. We're not there yet. Well, maybe I'll come back to this when we finish the covered call. But again, here's the protective put. So I won't read through it all right now. We're going to finish up with the cover call. But you can see here's all the strategies. And in CFA level 2, you get into some more complex strategies. So here's a bear call spread, a bear put spread, a bear spread, et cetera, et cetera. You can see there's lots of strategies that you can do with options. Again, the curriculum is quite okay. But if you want to go to a resource outside of the curriculum to complement the curriculum, then I highly recommend the Options Industry Council website. So now we're going to run through an example of a covered call. So for a position consisting of a stock bought at $39 and a call option at $40 that was sold for $3, calculate the following: the net cost of the position, the break-even stock price at expiration, the maximum gain, the maximum loss, the profit loss at a stock price of $39 at expiration, and the profit and loss of a stock price at $32 at expiration. Okay, so I bought the stock at $39 and I'm selling the call for $3. So you can see the net cost of the position is buying the stock at $39 minusing the premium. So there's two ways of looking at covered call strategy. One is that it's reducing your buying price for the stock. Or number two, you can look at it that you're increasing your yield, okay, because you're receiving an income of 3. Anyhow, the break-even stock at expiration then has to be $36. The maximum gain, if I get called out, you can see the call option is at $40, and I paid $36 for that, so my maximum gain is the $4, okay? The maximum loss is going to be the $36. The stock price could go down to 0, okay? So we have same risks of owning the stock. Now, the profit at loss, if the stock is at $39 at expiration, my break even is 36. So you can see 39 minus 36 is $3. But if the stock profit loss at 32 at expiration, I'm going to have -4. Now, I put a star there because that's just an unrealized loss at 32. There's no need to sell, okay? So I have an obligation to sell at 40, but the stock price is 32. The option's not going to be assigned, okay? Because the buyer of the option is going to go out and buy the stock at 32 if they want. So the option's going to expire. The stock price is at 32, and I have an unrealized loss at $32 of $4. But I don't need to sell the stock. I can wait. In fact, I can, if the option expires, I can write more calls and collect more income. And as long as I'm doing that at a higher price than what I bought the stock at, then I'm assuring myself that I'm not going to have any capital losses, okay? And that's why the covered call strategy can be fairly conservative, because yes, it's an obligation to sell, but I can make a contract for that obligation at a price that guarantees me a profit. So now we're looking at a graph with the payoffs and profits for a covered call. Now recall, if I'm just long on the stock, then the graph is just going to be the straight bar here. I buy at a certain price, and as the stock price goes up, there's my profit, okay? But when I write a call, when I do a covered call, then I have the obligation to sell at 40. So that's why we said here, that's the first thing to understand, is I'm giving up that upside, okay? Because I'm going to have, if I get called out, if the stock price goes up, recall I bought the stock at 39 and I received a premium of $3. So my buying price was 36. I wrote the call at 40. I have the obligation to sell at 40. So 40 minus my 36 stock price, I have a profit of $4, okay? So I've limited my upside to $4. I'm foregoing this if there's a sharp rally. But again, if I got called out, I have the cash. I can rebuy the stock and sell more calls and roll over the position, okay? So we can see here we have a loss. So our break even is $36. We talked about that. We have a loss if the stock price is less than $36. But again, that's unrealized loss. It's only a real loss if I sell the stock. So again, you know, your outlook for a cover call strategy is one that you'd want to own the stock anyhow, okay? So I'm happy to own the stock. If it goes down, that's fine. I'm in a buy and hold situation. In the meantime, I'll write some calls, collect the premium, you know, decrease my average buying price, or increase my yield, whichever the way you want to look at it. Give up some potential upside, but if I don't get called out, then I've greatly increased my yield, okay? So not too difficult to understand. You can see here the graph. Where does it kink? It kinks at the $40, which is the exercise price, because that's limiting my upside, okay? So the best thing to do right now is a practice question to check our understanding. An investor purchases 100 shares of common stock at 50 euros each and simultaneously sells call options on 100 shares of stock with a strike price of 55 euros at a premium of €1 per option. At the expiration date of the options, the share price is 58. The investor's profit is closest to A, 400 euros, B, 600 euros, or C, 900 euros. Okay, I hope that you're going to see that these covered call questions are actually not all that difficult if you just talk your way through it again. You know, it's just buying and selling stocks. So I bought 100 shares at 50 euros, okay? So that's my price. I bought at 50 euros. And I've sold the call option. I have an obligation to sell at 55, okay? So sell at 55, and I bought at 50, okay? So that's a profit of 5 euros per share. And it says here that I sold at €1 per option, okay? Now I received that premium, so you can see here I'm limiting the upside. Remember how the graph works? On a covered call, I'm limiting the upside and I'm limiting my profit. So what's that profit now? It's 6 euros per share, okay? And I purchased 100 shares. I have a maximum profit of 6 euros per share times 100. So you can see the correct answer is going to be B, okay? So let's just look through this. And again, remember, I sold the call, so I have an obligation to sell. Think about it from the buyer side. They've got the right, but not the obligation to buy at 55. And at expiration, the stock is at 58. So from the buyer's point of view, buy low, sell high, yes, the option is going to be exercised. So you have to understand that. I'm going to be called out, okay? And then you just have to work out. I bought at 50, I'm selling at 55, and I sold the option at €1 per option, okay? So let's just go through this. Because the price at expiration is greater than the exercise price, the investor collects the premium plus the difference between the strike price and the purchase price. So that's the exercise price minus the purchase price plus the premium. And don't forget it's on 100 shares. So 100 shares times 55 minus 50 plus the 1. That's the little calculation that we did up here. Okay. So just down here, here's some of my notes. Bought 100 shares at 50 euros. Share price now 58. You can see the profit of 100 times 8. That would be clear if you held on to the shares, but no, you sold the obligation to sell at 55, okay? And you received 100 euros for that, the €1 times the 100 shares. The buyer of the call will exercise. They can buy for 55 and sell for 58. So the profit is the 55 minus the 50 times the 100 shares plus the 100 for the premium. And again, in summary, the covered calls are giving away the upside, okay? So again, I think these questions are not too difficult. You just have to work your way through buying and selling, you know, buy low, sell high. Okay, here's another question, but there's considerably more to read, and that happens on the CFA Level 1 exam. Sometimes they give you a lot of information, you know, and you have to, speed is a skill, skill gets rewarded. So you need to pay attention. Okay, the recent price per share of Dragon Vacations is $50 per share. Calls with exactly 6 months left expiration are available on Dragon with strikes of 45, 50, and 55. The prices of the calls are $8.75, $6, and $4 respectively. Assume that each call contract is for 100 shares of the stock and that initiation of the strategy, the investor purchases 100 shares of Dragon at the current market price. We see the current market price is $50, okay? Further assume that the investor will close out the strategy in 6 months when the options expire, including the sale of any stock not delivered against exercise of a call, whether the stock price goes up or goes down. If the closing price of the Dragon stock in 6 months is exactly $60, the profit to a covered call using the $50 strike call is closest to A, $400, B, $600, or C, $1,600. Okay, this question's not too difficult. They just gave you a lot of red herring information, so you have to zoom in on the last sentence always. If the closing price of Dragon stock in 6 months is exactly 60, the profit to a covered call using the $50 strike call. So you have to come up here and look at that $50 strike call, and you have to look at the price of the calls, $6, okay? Now I know I purchased 100 shares of Dragon, okay, and I sold those calls. So 100 shares times $6 equals 600. That's the premium that I received, okay? Now I bought the stock at 50 and I have an obligation to sell at 50 because that's the strike price that we're using. So 50 minus 50 means I'm going to have zero capital gain. My maximum profit is just going to be the premium that I received. So the correct answer is B. Not a lot to that question. You can see an awful lot of writing, a lot of numbers here of strike prices at 45 and 55 and the price of the calls. But in fact, what we need to zoom in is what did I buy the stock at? $50. What is my obligation to sell at? $50. Zero gain. And I sold the options. So 100 shares times the premium 6. So I have 600. Okay. So the investor bought at 50 and using the $50 strike price means zero profit. It's a covered call, obligation to sell in exchange for the premium. The profit to the investor is the 100 shares times the $6 premium, and that's B. So actually a fairly easy question in my humble opinion. Now we're moving on to the protective puts, and protective put is when you're long the stock, you own the stock, and you're long the put. So when I buy a put, that gives me the right to sell. The right but not the obligation to sell, okay? So any gain on the stock will be reduced by the premium that I paid for the put. Now why did I buy that put? Because it's like buying insurance. The put buyer pays for protection against the stock price falling below the strike price. If the stock price goes down, but I've bought that put, I've got the right but not the obligation to sell at a certain price. So I've limited my downside. I've protected my downside, and that's why it's called a protective put. I've protected my downside. Not a difficult concept to understand. I own a stock. I'm worried that the price could go down. Maybe I'm going to be on vacation, out of touch for a certain amount of time. Well, I could, as insurance, I could buy some puts, and if the stock price was to tank, well, I'd have the right to sell it at the exercise price, and I've limited my downside. So we're going to run through this example here where an investor buys a stock at $41 and buys a $40 put for $3. Calculate the cost of the position, break-even stock price at expiration, the maximum gain, the maximum loss, at a stock price of 47 at expiration, what's happening, and at a stock price of 38 at expiration, what's happening. Again, this shouldn't be too difficult. Remember, a protective put is I buy the stock, I'm long the stock, and I buy the put as insurance to protect my downside. So the cost of the position is the $41 plus what I paid the premium for the put, which is $3, so it's $44. So the break-even stock price at expiration is the 44. The maximum gain is unlimited. I bought the stock, okay? I have the right to sell it, not the obligation to. So again, it's no different than owning the stock. The maximum loss is the $4 if the stock price is below 40, because I have the right to sell at 40 and my cost was 44. So you can see I've protected my downside to a maximum loss of $4. At stock price of 47, My profit is $3, the 47 minus the 44. Again, that's an unrealized gain. I don't have to sell my stock, but nevertheless, in terms of the CFA type questions, what is my profit? My profit on paper at that time is $3. If the stock price is at 38, I have a loss of $4, which is my break even is 44, and I have the right but not the obligation to sell at 40. Okay, so I'd have the loss of $4. That's my maximum loss. Okay, I could exercise the option. It gives me the right to sell at 40. The stock price is at 38. Now again, buying a put gives me the right but not the obligation. If I thought it just dipped down, I don't have to exercise. That's my choice. I have the right but not the obligation. Okay, so now we're going to look at the chart. So if I'm long, protective put, I'm long the stock. So you can see the top part of the graph is no different than being long on the stock. Okay, now I've bought the put, which gives me the right but not the obligation to sell at 40. So remember, I bought the stock at $41 and the price of the put was $3. So my break even was $44 in terms of the break even. There it is. And also my maximum loss, then I have the right but not the obligation to sell at 40. So my maximum loss, I've limited my maximum loss here to the $4. Okay, so again, this graph is not too difficult to understand. Remember that I'm long the stock, so I'm maximum on my upside, and there's my break even at 44, and my maximum loss is at 40. So I draw the kink. The kink is at my $40, and my maximum loss is the $4 from 44 to the 40. Okay, not too difficult. Okay, before we jump into the practice problems, I'll just go outside the CFA curriculum here, back into the Options Industry Council, and I'm looking at the protective put, sometimes called a married put. So again, here's the description. A long put option added to the long stock ensures the stock's value. The choice of strike price determines where the downside protection kicks in. If the stock stays strong, the investor still gets the benefit of upside gains. In fact, the short-term forecast brightens before the put expires. It can be sold back to recoup some of its cost. However, the stock falls below the strike price as originally feared. The investor has the benefit of several choices. One option is to exercise the put, which triggers the sale of the stock. The stock price sets the minimum exit price. If the long-term outlook has turned bearish, this could be the most prudent move. If the worst seems to be over, though, an alternative for still bullish investors is to keep the stock and sell the put. This sale should recoup some of the original premium paid and may even result in a profit. If so, it lowers the stock's cost basis. Okay, just scroll down a little bit. If the investor remains nervous, this put could be held until expiration to extend the protection for as long as possible. Then it either expires worthless, or if it's sufficiently in the money, is exercised and the stock would be sold. Okay, so the put could provide excellent protection against downturn during the term of the option. The major drawback of the strategy is its cost, which raises the bar on netting upside profits. Investors who aren't very bullish might have a better strategy alternatives. So again, I just wanted to read through that, but you can see they've got an example here of long 100 shares XYZ stock and your long 1 XYZ put. So the maximum gain is unlimited, as we said. It's the same as owning the stock. The maximum loss is the stock purchase price minus the strike price minus the premium paid, okay, which we saw. Okay, just scrolling down quickly. I'm not going to read more, but you can see it's the outlook. You're bullish overall because you want to own the stock, but you worry about sharp temporary decline in the underlying stock price. There's some summary. There's some motivation here. Some maximum loss, maximum gain as well, profit and loss, the break even, volatility, time decay, expiration at risk. So once again, just to remind you that sometimes you can go outside of the curriculum to help complement your education, and this is one website that I highly recommend. So let's jump into a practice question on the protective puts. An investor purchases ABC stock at $71 per share and executes a protective put strategy. The put option used in the strategy has a strike price of $66. It expires in 2 months and is purchased for $1.45. At expiration, the protective put strategy breaks even when the price of ABC is closest to A, $64.55, B, $67.45, or C, $72.45. I like this question because it's not talking about the gain or the loss, it's talking about the break even, and that's what the LOS covers. Okay, that's why it's important to understand max loss, max gain, break even, etc. So C is correct because the break even, to break even, the underlying stock must be at least as high as the amount expended up front to establish the position. So to establish the protective put, the investor would have spent $71 to buy each share of the stock plus $1.45 equals $72.45. This question is really easy. You're long the stock and long the put. You've bought the protection. So I wrote here, this is my comment, don't overthink. What is my break even on anything? It's what I paid. So I paid $71 and I paid $1.45 for the long put. That's my break even. Okay, really easy question. Now, they're giving the strike price as 66 and et cetera, et cetera. This question is just asking the break even. It's $71 plus the that I paid for the stock plus what I paid for the option. So just two practice questions to finish this LOS. The first one, a stock is trading at $18 per share. An investor believes that the stock will move either up or down. He buys a call option on the stock with an exercise price of $20. He also buys two put options on the same stock with an exercise price of $25. The call options cost $2 and the put options cost $9 each. The stock falls to $17 per share at the expiration date and the investor closes his entire position. The investor's net gain or loss is A, $4 gain, B, $4 loss, or C, a $3 loss. Okay, this question is actually talking about a long strangle. And a long strangle is where I buy both a call and a put, but at different exercise prices. Okay, so maybe this is a little bit beyond CFA level 1 in terms of the LOS. Nevertheless, I think it's good practice. So I put this on the CFA continuum of maybe a little bit of a more difficult question. Nevertheless, let's see what's going on. You're buying a call option, one call option with an exercise price of 20. So I have the right to buy at 20. Okay, so let's just first do that. I also buy two put options with an exercise price of 25. So that gives me the right to sell at 25. Okay. Now this has a cost. Okay. So I bought, it says here, I bought a call option and the call cost $2. So you can see the cost of the options, $2 times the one option is $2. I don't even need to bring up my calculator. And he's buying two put options at $9 each. So $9 times the two put options is 18. Plus 18 plus 2 equals $20. Okay, I didn't have to bring up my calculator. Now it says here the stock falls at expiration to $17. So I have the right to buy at 20, but the stock is at 17. So in terms of the call option, it's going to be worthless, correct? Because the price at expiration of the underlying is less than the exercise price. We've seen that many times. So that's zero. Okay, so we know we spent $20. Let's see if we made any money on the put. Well, on the put, I have the right to sell at 25, and I can buy the stock at 17, sell high, buy low. So I can see I've made a profit of $8. Okay, so you can see the investor made $16 on the puts, because don't forget there was two puts. So that's 8 times 2 equals 16. So I made 16 on the puts, but I spent $20 to buy the three options. So I have a loss of $4. Okay, so that was the profit on my puts, but here was my original cost. So I had a net loss of $4. So the correct answer was B. Okay, now not impossibly difficult, but you just have to spend some time paying attention to what are my rights and obligations and what's happening at expiration. I think this is a very good practice question to get up to speed on the options. Okay, now we're just going to finish this LOS with one last practice question. So one last practice question. The recent price per share of Win Big Inc. is €50 per share. Verna Hillsborough buys 100 shares at 50 euros. To protect against a fall in the price, Hillsborough buys one put covering 100 shares of Winbig with a strike price of 40 euros. The put premium is 1 euro per share. If Winbig closes at 45 euros per share at expiration of the put, and Hillsborough sells her shares at 45 euros, Hillsborough's profit from the stay put is closest to A, negative 1,100 euros, B, negative 600 euros, or C, positive profit of 900 euros. Again, I don't think this question is too bad, so we have to say that she bought the shares at 50 euros, okay? So spent 50 euros for the shares, and then also bought the put for 1 euro. So you can see the break even is 51 euros, okay? Now you've bought some downside protection, which gives you the right, but not the obligation to sell at 40, okay? So it says here, though, that she sells her shares at 45. So the strike price is at 40. At expiration is at 45. You bought the put. You have the right to sell at 40. Why would you exercise at 40? It says here that she sells the shares at 45. So that would be, what is her loss? Well, it cost me 51. That's my buy. In this case, I'm buying high and selling low, and I sold at 45. So you can see that is a difference of 6 euros per share times the 100 shares. So you can see in this case, the correct answer is B. It's a loss of 600 euros, okay? Now realize that's an unrealized loss on the stock. She doesn't have to sell her shares at 45, but this says that she closes, she sells her shares, so that would be a realized loss of 600. Don't forget, when you're long on the put, you have the right to sell. You do not have to sell, okay? So a nice little question to end on. Again, I don't think too difficult if you just work through buying and selling and what your rights and obligations are. And that's the last slide for this LOS. Thank you.